Hey everybody, Alan here from Slow Fortune, and in today's video I want to talk to you about things to check on your superannuation statement. So here in Australia, it's time for the super funds to send out their annual statements. You may have already got yours depending on your super fund, but generally they sort of come out around August to October. If you're like most people, what you'll do is you'll get the statement, you'll open it up, have a look at the balance, and then probably file it somewhere because you don't really know what else you should be doing with your super statement. So in this video, I want to help you just get a feel for a couple of the things or 5 things you should be looking at on your super statement. Number 1, contributions. So here in Australia, your employer should be making superannuation contributions to you at a rate of 9.5% of your annual salary. So if you earn $100,000, for instance, in a year, so simple for my maths, 9.5% of that is $9,500. By law, super contributions should be made at least quarterly by the 28th day of the next month. So if one's due, say, at the end of December, then you've got until the 28th of January for your employer to make that payment. In practice, a lot of employers pay more regularly than quarterly. Some will pay monthly, some will pay fortnightly. It may depend on your payroll cycle, and they may do it as part of that. But the important thing is have a look on your statement and check, have you received all the contributions that you should have received over this period of time? So generally that'll be a financial year. Now, some employers, unfortunately, don't do the right thing and they don't pay their employees their super guarantee, and they just work in the theory that you won't notice it or you won't say anything. If that is the case, you let the Australian Taxation Office know and they will chase it up with your employer anonymously, but they will then audit your employer and they can get in all sorts of trouble for not making those payments. Also remember, look, there may be some timing issues with it as well. So assuming your employer is making contributions, say there's contributions due at the end of June, they might not be made until sometime in July, so they may not appear on your statement. So saying that ones for the previous year that were made in, say, the previous June that then went through in that next July probably would be on that statement for you as well. The main thing is to just get a feel what is going in. If you're making voluntary contributions as well, make sure that they're going in as well. Secondly, where is your money invested? So typically most super funds have a range of investment options, and we know from my understanding of investor psychology and the way people make decisions that generally more is not better. As in, if you've got 90 investment choices in your super fund, studies will show you are more than likely to do nothing and make no choice, as opposed to if you only had, say, 4 or 5 to choose from. That's a whole other video that we can get into that. The default option in your super fund is normally called a balanced fund. In our industry, balance traditionally means it refers to the mix of assets. So how much in shares and property, for instance, which are called growth assets, and how much are in, say, cash, bonds, fixed interest, which are more defensive assets. A balanced fund typically is around 60-40, meaning 60% in shares, property, 40% in fixed interest and cash. There's a number of balanced funds out there, or so-called balanced funds out there in Australia, that actually aren't that true to label, and you may find that they actually have more of an 80-20 allocation or even slightly more. That in itself isn't an issue. In fact, I'm a big believer that whilst you're working, and for most people, having the most you can stomach in long-term growth assets is the best thing for you. Over the long term, that will, on average, perform the best for you. But you've got to understand the volatility that's associated with that, as in how much it will go up and down. For now, the important thing is to have a look at where your money is invested. If it's unclear, ring up the fund and find out, or check online, see what material they've got, and have a think about whether this is the right place for it. Generally speaking, the greater your time frame, the more you can allocate to growth investments. Thirdly, what insurance cover do you have within your superannuation fund? So most super funds have some kind of automatic insurance coverage. You may have been through the process where you've applied for more cover as well. So in this step, what I'm asking you to do is have a look at what there is. There's probably some life insurance, some total and permanent disability or TPD insurance, and probably some income protection insurance. Your death and TPD cover are usually for the same amount. So it might be, say, $200,000 of death and TPD. And it kind of happens on whichever one happens. So if you became totally and permanently disabled, you get the payout, and then usually your death cover drops to zero. Those two are kind of linked. Have a look at a couple of things importantly. Are you down as a smoker or a non-smoker with these rates? There are some funds that by default will put you down on smoking rates rather than non-smoking rates. And smoking rates sometimes can be 50, 60% higher than non-smoking rates. So you may find you're actually paying a whole lot more for your insurance than what you need to be. Secondly, have a look at what occupation they've got down for you. So for total and permanent disability and income protection, the risks there are very much based on your occupation. If you work in a heavily manual type industry, you will find that your class is a higher risk than someone like me. Perhaps it just sits in an office. I'm a lower risk worker when it comes to a lot of those sort of standard total and permanent disability injuries. So for the purpose of this step, have a look and make sure that your occupation is correct. And again, if it's unclear, ring the fund and ask them these questions. When it comes to income protection, just have a look at what you've got. So some of them will have, say, a 30-day wait or a 60-day wait. Now, what this means is that if you're unable to work your usual occupation due to sickness, injury, that, say, a 30-day wait, after 30 days, your benefit starts accruing. So what that means is you're on your own for the first 30 days. You use up sick leave, annual leave, you get no help from the fund. If you're sick on the 31st day, then your benefit starts accruing, and usually it's paid 30 days in arrears. So if you're off work, seriously off work, and you're off work, say, for more than 30 days, it's going to be not until day 60 or 61 that the benefit actually starts getting paid into your bank account. If you've got a 90-day waiting period, as is popular in a lot of these funds, then that's 3 months. So your benefit won't start accruing until the end of the 3-month period. So you're on your own for those first 3 months. Really, really important to understand at this point just what you've got. Also understand how your benefit's calculated as well. If it's the standard default cover that the fund's given you, then what you'll find is you're probably buying units in the fund. But again, ask the question, understand, is this based on my occupation? Is it based on length of service? Does it decline as I get older? Ask the fund the question. Number 4, fees. What are the fees in your super fund? Now, these will be disclosed on your statement. You will find 2 areas on your statement they're disclosed. Generally on like what I call the cash flow area, where it shows sort of opening balance, contributions in, growth in investment balance, fees out, to give you your final balance for the period. That's one set of fees, and then usually the fund-specific fees. There's also a second set of fees that the investment managers charge for managing the money and getting the returns. Now, what happens is, say they make an 8% return and they charge a 0.5% fee, then what the fund actually receives is 8 less the 0.5%, so 7.5%. So you don't see the 0.5% generally on a statement, but it is there coming off the investment returns. So when I say you don't see it on a statement, I mean in that cash flow section, because further down in your statement, there'll be a section on fees and it will talk about the overall fees. Importantly, sometimes it's just in dollar terms, work this out as a percentage. Take that amount, say it's $1,000 fee, and say your balance is $100,000 in the fund. You do 1,000 divided by 100,000 times by 100, and that'll give you the percentage. So in that instance, a $1,000 fee in total on $100,000 is 1%. Fees aren't everything. As in, there's a lot of talk in our industry about finding the cheapest fund. The cheapest fund may not be the best fund, but the same token, the most expensive fund probably isn't the best fund either. So again, conversation for another day or a video for another day, but just understand at this point what your fees are. Finally, number 5, check your beneficiaries. You're going to die one day. We're all going to die one day. It's inevitable. Your super fund probably has a beneficiary noted on it. You will see this somewhere on your statement. It will have something like beneficiary, and it will either have people's names or a person's name, or it will say something like no beneficiary noted. So here's how superannuation works. If there's a beneficiary noted, say it's your partner, your spouse, then in the event of your death, your super balance plus any insurance that sits in the fund that gets paid out gets paid to that person who's the beneficiary. If there's no one noted as beneficiary, then generally what happens is the superannuation trustee will pay that money to your estate, and then the executor of your estate makes the decision about where it goes. But think this through. If there is a beneficiary, it completely avoids your estate. That money bypasses your will and can go straight to somebody. Now, here's the problem that I see. As a financial planner, when I was working as a planner, I just saw a number of people come in over the years who still had their ex-wife or ex-husband as the beneficiary on their superannuation fund. And I'll have to explain to them and say, did you know that if you died yesterday, that your ex-wife would have received the sum of $120,000, whatever's on your statement, whatever your balance was, that's what they would have got because you haven't changed your beneficiary, and that's who the trustees are going to pay it out to. Have a look at the beneficiaries on your super fund. Make sure that you agree with them, that they're still current, still valid. Check with your fund. You may be able to get what's called a binding death nomination. These, just from a legal point of view, make it a little more watertight. Still not perfect, but a bit better than the standard beneficiary nominations that you can do. But importantly, make sure that that beneficiary notification or nomination reflects who you want to receive your money. So you have it, 5 things to look at with your super fund. Your contributions, where's the money invested, what insurance do you have, what are the fees, and who is the beneficiary. The whole thing may not take you any more than sort of 15, 20 minutes. You may need to make one phone call to your super fund to get the answers. But if you do this, you will know more about your super probably than about 60 or 70% of people in Australia. So go do it. If you're unsure of anything, leave a comment. Let me know what questions you've got, and I can do future videos or articles on this. Again, would love it if you could like this video, share it as well. That would be fantastic. Thank you for watching.